What is inflation and why does it matter in today's economy? Inflation, a term that often surfaces in economic discussions, refers to the rate at which the general level of prices for goods and services rises, leading to a decrease in purchasing power. This concept is pivotal in understanding economic health, as it affects everything from individual savings to national economic policies. Inflation can be likened to an economic bubble in that both phenomena involve rapid changes in value and can lead to significant economic disruptions if not managed properly. Recognizing inflation's role in the economy is crucial for both consumers and policymakers, as it influences interest rates, wages, and overall economic stability. Causes: what drives inflation, and how do economic bubbles fit in? Inflation can be driven by various factors, broadly categorized into demand-pull inflation, cost-push inflation, and built-in inflation. Each of these causes can interact with economic bubbles, exacerbating their effects. Demand-pull inflation. This occurs when the demand for goods and services exceeds their supply, causing prices to rise. Often, this scenario unfolds during economic booms when consumer confidence is high, leading to increased spending. For example, the housing bubble of the early 2000s saw a surge in demand for real estate, pushing prices up and contributing to inflation. As more buyers entered the market, the demand outpaced supply, creating a classic case of demand-pull inflation. Cost-push inflation. This type of inflation happens when production costs increase, leading to a decrease in the supply of goods and services. A notable example is the oil crisis of the 1970s, where geopolitical tensions caused oil prices to skyrocket, increasing production costs across various industries. This situation can also be seen in economic bubbles, where speculative investments drive up the cost of commodities, leading to widespread inflation. Built-in inflation. Often referred to as wage price inflation, this occurs when workers demand higher wages and businesses raise prices to maintain profit margins. This cycle can be exacerbated by economic bubbles, where rapid increases in asset prices lead to higher wage demands and subsequent price hikes. For instance, during the tech bubble of the late 1990s, the surge in stock prices led to increased wealth and spending, contributing to inflationary pressures. Effects. How does inflation impact consumers, businesses, and the economy? Inflation affects various aspects of the economy and daily life, much like the aftermath of an economic bubble burst. For consumers, inflation means that their money buys fewer goods and services, leading to a decrease in purchasing power. This can be particularly challenging for those on fixed incomes, such as retirees, who may struggle to maintain their standard of living as prices rise. For businesses, inflation can be a double-edged sword. On one hand, it can lead to higher revenues if companies can pass on increased costs to consumers. On the other hand, if inflation is too high, it can create uncertainty, making it difficult for businesses to plan for the future. This uncertainty can dampen investment and economic growth, similar to the effects seen after a bubble bursts. At the macroeconomic level, inflation can influence interest rates, as central banks may raise rates to curb excessive inflation. This can affect everything from mortgages to business loans, impacting economic activity. High inflation can also erode the value of savings, leading individuals to seek alternative investment options to preserve their wealth, much like the flight to safety seen during the collapse of an economic bubble. Historical examples. What can past inflationary periods teach us about economic bubbles? The 1970s oil crisis serves as a stark reminder of how external shocks can lead to significant inflationary pressures, akin to the rapid deflation seen after a bubble bursts. During this period, geopolitical tensions in the Middle East led to a sharp increase in oil prices, which in turn caused widespread inflation across the globe. Countries heavily dependent on oil imports faced skyrocketing production costs, leading to higher prices for goods and services. The housing bubble of the early 2000s provides another example, where inflated real estate prices eventually led to a financial crisis. As housing prices rose rapidly, fueled by speculative investments and easy credit, inflationary pressures built up in the economy. When the bubble burst, it resulted in a severe economic downturn, highlighting the interconnectedness of inflation and economic bubbles. These historical examples underscore the importance of sound economic policies and the need for diversification in energy sources and investments to mitigate the effects of inflation and prevent the formation of economic bubbles. Protection strategies. How can you shield yourself from inflation and economic bubbles? While inflation and economic bubbles are macroeconomic issues, individuals can employ strategies to protect themselves. One effective approach is investing in real assets, such as real estate or commodities, which tend to appreciate over time and can act as a hedge against inflation. For example, owning property can provide rental income that keeps pace with inflation, while the property itself may increase in value, offering protection against both inflation and asset bubbles. Investing in stocks is another strategy, as companies that can pass on increased costs to consumers often maintain their profit margins, leading to potential growth in stock value. Additionally, inflation-protected securities, such as Treasury inflation-protected securities, TIPS, in the United States, offer returns that rise with inflation, preserving the purchasing power of your investment. Diversifying your investment portfolio can also mitigate risks associated with inflation and economic bubbles. By spreading investments across different asset classes, you can reduce the impact of inflation and the volatility associated with bubbles on your overall portfolio. Lastly, maintaining a budget that accounts for inflationary pressures and potential bubble formations can help manage expenses and ensure financial stability. In conclusion, understanding inflation and its causes, effects, and historical examples provides valuable insights into how this economic phenomenon shapes our world, often in conjunction with economic bubbles. By employing protection strategies, individuals can better navigate the challenges posed by rising prices and safeguard their financial future.